Have you ever wondered what the quietest signals in the financial world are saying right now? The ones that don't make headlines, the ones buried deep inside the system, where only those who truly pay attention can see what's coming. The signals that don't shout but whisper, softly at first until the echo becomes impossible to ignore. Because one of those signals has just done something extraordinary, something that hasn't been seen since the year 1929. And history tells us that whenever this particular event takes place, the world of finance, the world of jobs, the world of everything you know about money is about to change in ways most people are not prepared for. The yield curve. It sounds like some complicated term invented by economists to confuse everyone, but in truth, it's one of the simplest and most brutally honest indicators we have. A quiet chart that maps the heartbeat of the economy by showing how interest rates behave over time. On one side, you have short-term rates, the cost of borrowing money for a few months. On the other side, you have long-term rates, what investors demand to lend their money for many years. Normally, that curve slopes upward because the future is uncertain, and lenders want to be paid more to wait. That's logical, that's healthy, that's how it should be. But sometimes, when the system begins to twist under invisible pressure, when fear creeps in about what lies ahead, that curve turns upside down. Suddenly, short-term borrowing becomes more expensive than long-term lending, meaning people would rather lock their money away for a decade than lend it for 6 months. That strange reversal is what we call a yield curve inversion. And through every era of modern history, it has preceded every major recession, every crash, every wave of panic that rewrote the rules of finance. Now imagine this. Back in April of 1928, a year before the Great Depression, that same inversion appeared. It was subtle at first, barely noticed outside a handful of analysts, but it was there whispering that the economy was overheating, that credit had grown reckless, that the market's euphoria had reached dangerous heights. Yet despite the warning, the stock market kept climbing. In fact, it soared almost 50% higher after the inversion began. Newspapers called it a golden age. Investors felt untouchable. And then, in October 1929, everything collapsed. The Dow Jones lost 80% of its value, unemployment exploded to nearly 25%, and the Roaring Twenties came to an abrupt and violent end. That inversion was not a coincidence. It was the quiet alarm before the world changed forever. Fast forward through the decades, and you see the same rhythm repeat, almost like a haunting melody that never goes away. In 1969, the yield curve inverted, and within 5 months, a recession arrived. In 1973, it happened again, right before an oil shock sent energy prices through the roof and shattered consumer confidence. The economy shrank, unemployment rose, and people began lining up at gas stations that had run out of fuel. Then came 1979, another inversion, another downturn, followed by 1981, when high interest rates crushed business borrowing, and households began to struggle under soaring costs. Each time the inversion came first, the recession second. But here's the unsettling part. Not every inversion brings immediate pain. Sometimes it comes with a strange delay, a deceptive calm that lulls everyone into believing the danger has passed. In 2006, for example, the curve inverted months before the housing bubble burst. For more than a year, markets continued to rise. The economy looked solid, unemployment was low, and financial pundits proudly declared that the yield curve had lost its power. And yet when the bubble finally burst in 2008, the world entered the worst financial crisis since 1929. And now, once again, we find ourselves in that same eerie space between warning and consequence. The curve inverted in August 2022, flashing its unmistakable signal that trouble was coming. But instead of falling, the market rallied. Instead of weakening, the economy appeared to grow stronger. Unemployment stayed near record lows. Consumers kept spending. Tech stocks surged. Artificial intelligence became the new gold rush. People looked at the data and said, "See, this time is different." But those words, "this time is different," are the most expensive words ever spoken in finance, because they always appear right before the fall. Just a little break, I opened a free Telegram community where I teach how to earn money with YouTube and build channels like the one you're watching. If you want to understand how to do it, there's the link below, back to before. The deeper you look into the numbers, the stranger it gets. The yield curve today isn't just inverted, it's deeply inverted, far more than in 2006, far more than in 1989, even rivaling the extremes last seen in 1929. That means short-term money has become drastically more expensive than long-term money. Banks which borrow short and lend long feel the squeeze first. Credit starts drying up quietly, loans become harder to get. Consumers begin leaning on credit cards to cover everyday costs. It's not dramatic at first. It's slow, invisible, silent. But slowly, pressure builds behind the walls of the financial system, and when it finally releases, it's always sudden. Think about how this fits together. In the 1970s, when the curve inverted, oil prices surged, wages collapsed, and recession came quickly. In the 1980s, the same pattern unfolded, but back then government debt was manageable, savings were higher, and there was room to spend our way out. Today we're living in a world drowning in debt. Governments, corporations, households, everyone. When the next shock comes, there's far less margin for rescue. The same medicine that cured old recessions, cutting rates, printing money, borrowing more, now carries dangerous side effects. That's what makes this inversion not just another warning, but potentially the beginning of a structural change in the world economy. If you look at 1989, you'll find another interesting parallel. The curve inverted early that year, stocks kept climbing for 12 months, and then recession hit. That one was shallow because the inversion was mild. Today the inversion is much deeper and has lasted far longer. History shows that the deeper the inversion, the harsher the downturn that follows. It's like the tension in a stretched rubber band. The more it pulls, the harder it snaps back. Now let's revisit 2006 again, because that example holds a chilling lesson. Back then the economy was humming, housing prices were skyrocketing. The Federal Reserve was confident. The unemployment rate stayed below 5%, just like now. And still, underneath it all, the yield curve was screaming danger. 17 months later, the worst financial collapse in modern times began. And here's the most crucial point. The time delay between inversion and recession doesn't predict how mild or severe the downturn will be. In fact, the opposite often happens. The longer the delay, the bigger the eventual collapse, because it gives speculation time to grow unchecked. That's exactly what happened in 1928. The yield curve inverted more than a year before the Great Depression began, while the stock market kept rising. People were euphoric, just as they are today with the rise of new technologies, booming asset prices, and low unemployment. Yet when the reckoning arrived, it was the most devastating collapse the world had ever seen. The parallels are uncanny. The depth of the inversion now matches that of 1928 almost perfectly. The timing, the optimism, the denial, all aligned in a pattern we haven't seen in nearly a century. So let's talk about what happens next, because this is the part most people don't understand. The inversion itself isn't when the real damage begins. The real trouble starts when the curve begins to steepen again, when short-term rates start falling, not because the economy is strong, but because the market senses that something has broken and begins rushing into long-term safety. That's when recessions officially begin. And guess what? That process has already started. The curve is beginning to un-invert, shifting back toward normal, which means the countdown has quietly begun. Picture the economy as a long line of dominoes stretching from Wall Street to Main Street. The inversion is the moment the first one tips. For a while, nothing visible happens. The dominoes stand still, balanced, motionless. Then, without warning, the second one falls, and the motion spreads. Credit weakens, spending slows, companies reduce hiring, markets panic, and soon enough the chain reaction becomes unstoppable. That's how every cycle ends, not with fireworks, but with a whisper that turns into a roar. And here's the paradox that makes it so dangerous. The stronger the economy appears while the inversion is in place, the worse the crash tends to be afterward. Because strength breeds overconfidence, and overconfidence breeds risk. In 1929, unemployment was near 3% before the crash. In 2007, it was 4.4%. Both times people said, the fundamentals are strong. Both times they were wrong. The yield curve doesn't lie. It simply tells us that the foundation under our feet is shifting. It's important to understand that the yield curve doesn't cause recessions. It reveals them. It shows that the flow of credit, the lifeblood of the economy, has reversed. Banks can no longer profit from lending, businesses can't expand easily, and consumers begin to pull back. It's like watching the tide go out before a tsunami. Everything looks calm until you realise the water is retreating, because something massive is approaching. And right now, that's exactly what's happening. Corporate debt is at historic highs. Government deficits are ballooning. Consumers are carrying record credit card balances at the highest interest rates in decades. Meanwhile, the cost of money itself has skyrocketed. The financial system is holding its breath, and the yield curve is telling us that something has to give. The longer this imbalance lasts, the sharper the correction will be. When the shift comes, it will begin subtly. Maybe a few bank failures, maybe rising defaults in consumer loans, maybe a slowdown in housing. Then, like every cycle before, it will accelerate. Confidence will break, markets will plunge, and central banks will rush to cut rates. But by then, the damage will already be done. The pattern has repeated too many times to ignore. The only difference this time is scale. The inversion is deeper, the debts are larger, and the world is more connected than ever. That means the shockwaves will travel faster and hit harder than before. Oh, and I remind you that if you want to build a YouTube channel like this, you can join my free Telegram community with the link below, back to before. But let's remember something else. Crises, while terrifying, are also resets. They cleanse the system of excess. They force change. They spark innovation. The Great Depression led to the modern financial system. The 2008 crisis reshaped global banking. Whatever comes next will likely transform money once again, perhaps in ways we can't yet imagine. The question isn't whether it will happen, but whether you're paying attention before it does. So what can you do? History suggests that when the yield curve begins to normalise after a deep inversion, safety assets like treasury bonds often outperform stocks. Cash becomes valuable again. For individuals, it's a time to reduce risky debt, save more, and avoid speculation. Awareness is the most powerful defence, because those who recognise the signal early can prepare, while those who ignore it become its victims. And now, as the curve shifts back toward normal, we stand at the same crossroads our ancestors did in 1929. The same quiet signal is flashing, the same confidence fills the air, the same voices say everything is fine. But history doesn't forget, and neither should you. The yield curve has just done something not seen in nearly 100 years, and every time it has, the story that followed changed the world. So ask yourself, when the oldest and most reliable indicator in finance begins to repeat the pattern that preceded every major collapse of the past century, do you believe it's different this time? Or do you prepare for what always comes next? Because if the past has taught us anything, it's that markets may lie, headlines may mislead, optimism may blind, but the yield curve never whispers, without reason. And this time its message could not be clearer. So smash that subscribe and like button, let me know your thoughts in the comments. And I also want to remind you that if you want to build a YouTube channel, like the one you're watching now, and make money from it, I opened a free Telegram community with the link below. See you there, or in the next video. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.